Welcome to the Explainer. So if you've ever, peeked at a company's books and just scratched your head wondering how on earth they handle financing for massive, big-ticket purchases, well, you are definitely in the right place today. Grab your metaphorical notebooks because we're putting our accounting hats on. We're going to demystify a really fascinating topic: how businesses track the money they owe over time without throwing their entire balance sheet into total chaos. We're going to break down the logic step by step. Let's dive right in.
All right, here is our syllabus for today. First, we'll look at the big purchase scenario. Then, the ownership question. Third, we cover the hire purchase system, followed by the installment payment system. Fifth, we'll tackle the interest suspense account itself. And finally, we'll wrap up with the vendor's perspective.
Section 1, the big purchase scenario. Let's step out of the abstract and into the real world here. To really wrap our heads around the mechanics of these accounting systems, we kind of need a concrete example, right? So imagine you're a business owner. Let's say you run a bakery, and you desperately need a brand new, heavy-duty commercial oven. But understandably, you don't really want to drop all that cash up front. So what do? You finance it. You sign a contract, and boom, you now have a total debt of $1,200 spread out over the next couple of years. It's a simple number, sure, but how you actually record this $1,200 on your books, well, that changes dramatically depending on the specific legal agreement you just signed.
Let's actually break down that $1,200. The actual cash price of the oven, the principal, right, is $1,000. The remaining $200 is the total future interest you're going to pay just for the privilege of paying it off over time. Now, accounting for that $1,000 oven is relatively straightforward. You'll charge depreciation on the asset in the usual manner and show its depreciated value on your balance sheet, totally regardless of how you finance it. The real core problem, the actual puzzle we are solving today, is that $200 of future interest. How exactly do we track money we owe for time that hasn't even passed yet?
Section 2, the ownership question. Because in accounting, everything revolves around when it's officially yours.
Really think about it for a second. When does the asset actually become yours? Is it the exact moment you wheel that massive oven through the front doors of your bakery? Or is it the moment you make the absolute final payment, say 2 years from now? This isn't just some abstract philosophical debate. It's the core legal distinction that forces accountants to use completely different methods for recording the exact same transaction.
So, let's put these two financing systems head to head. Over under the hire purchase system, the title, meaning the actual legal ownership of the goods, passes to you only after you pay the final installment. You're basically just hiring the oven until the very end of the agreement. But alternatively, under the installment payment system, the title passes immediately upon signing the contract. You completely own it on day one. Let's see how that one little detail dictates the entire accounting process.
Section 3. The hire purchase system. Our straightforward, pay-as-you-go arrangement.
We'll start with the simpler method. So the crucial takeaway here is that because the ownership of the goods doesn't pass to the buyer until the very end, the interest is just accounted for progressively. You aren't recording that whole $200 block of interest on day one. Nope. Instead, the actual amount of interest is recognized and debited to your interest account simply and only as each specific installment falls due. It's neat, it's super clean, and you only record the interest when the time has actually passed to earn it.
Section 4. The installment payment system. This is where things get a bit more complex.
But what if you signed a completely different contract? Under the installment payment system, because ownership passes immediately upon signing, you, the buyer, are treated as a debtor for the full amount right from the get-go. Remember our $1,200 figure? You instantly owe the $1,000 cash price plus the $200 of total interest. You literally have to credit the vendor with the full amount payable right away. But wait a second. You can't just dump $200 of future interest into today's interest expense account, right? Because you haven't actually accrued it yet. We've got ourselves a serious accounting problem. We have to record a liability for future interest today, but we absolutely cannot recognize it as an expense yet.
Section 5. The interest suspense account. The brilliant accounting solution to our problem. Allow me to introduce the star of the show, the interest suspense account. At the time of purchase, the buyer debits the asset account with the actual cash price of the oven. Then, and here's the magic, they debit this interest suspense account with the total amount of interest. That's our full $200 to be paid over the life of the agreement. Think of it like an accounting waiting room or a holding pen. That $200 is parked there safely on the balance sheet. It acknowledges that we owe the money, but importantly, it keeps it completely out of our current expenses until it actually belongs there. Just imagine how wildly messy the books would get without this brilliant little structure.
Let's actually walk through the active flow of this holding pen step by step. Step 1. At signing, the total $200 interest enters the interest suspense account. It's just sitting there. Step 2. A month goes by and your first installment payment finally falls due. Step 3. Now that time has passed, a specific corresponding portion of that interest, let's say it's $10, is transferred out of the interest suspense account and into the actual interest account where it becomes a true recognizable expense. And this cycle just repeats. It repeats until the suspense account slowly, methodically drains to zero by the very end of the contract. It's a beautifully structured way to maintain balance.
Section 6. The vendor's perspective. Looking at the exact same deal from the other side.
So far, we've been looking at this entirely from the perspective of the buyer, our bakery owner. But obviously, there are two sides to every transaction. Let's flip the perspective and look at the companies selling the oven. Notice how the books compare here. It is quite literally a perfect mirror image. While the buyer debits the asset account, the vendor credits their sales account with the cash price. While the buyer credits the vendor for the full $1,200 payable, the vendor debits the buyer's account for that same full amount. And most importantly, look at the suspense account. While the buyer debits the interest suspense account, the vendor actually credits the interest suspense account with the total interest.
And honestly, this brilliantly illustrates the absolute consistency of accounting rules. Whether you're buying or selling under the installment payment system, that holding pen concept works exactly the same way. When each installment becomes due, the vendor simply transfers the actual amount of interest earned for that specific period right out of their interest suspense account and into their actual interest account as revenue. Both sides are slowly draining their suspense accounts over time. One is claiming an expense, while the other is claiming income.
We've seen how the interest suspense account acts as the absolute perfect bridge between immediate legal ownership and the slow, inevitable passage of time. It keeps the books perfectly balanced and completely accurate. But this whole concept of an accounting waiting room is incredibly powerful. Actually, it really makes you wonder if the suspense account neatly organizes our future debts here, where else in business might we desperately need an accounting holding pen? What other financial mysteries are out there just waiting to be transferred to the right account? Think about that for a bit. Thank you so much for joining me for this explainer. Keep asking those great questions, and I'll see you next time.